Get ready for a shocking truth. The world of finance is about to be turned upside down. Accenture, a global consulting giant, is set to acquire CyberCX, a leading cybersecurity firm. But here's where it gets interesting. This move has significant implications for the financial industry, and we're about to dive into the details. As we explore this development, it's essential to understand the context. Disclaimer: the performance of financial models, like the TipRank Smart Score, is based on back-tested results. But what does this mean exactly? Back-tested performance is essentially a simulation of how a strategy would have performed in the past, using historical data. However, it's crucial to note that past performance is not a guarantee of future results. The results are calculated by applying a model to historical data, making assumptions about the market and the firm's ability to execute trades. These assumptions may or may not be realistic and can significantly impact the back-tested returns. For instance, the model assumes that the firm would have been able to purchase the recommended securities and that the markets were liquid enough to permit trading. But what if these assumptions are flawed? Changes in these assumptions can have a material impact on the back-tested returns, making it challenging to rely on them as a predictor of future performance. Additionally, certain assumptions made for modeling purposes may be unrealistic and are unlikely to be realized in practice. It's also important to understand that back-tested performance has inherent limitations. Since trades have not actually been executed, the results may not reflect the actual trading process or the impact of material economic and market factors on decision-making. The model can be adjusted to maximize past returns, but this may not translate to real-world performance. And this is the part most people miss. Back-tested results are often presented gross of fees without considering the effect of transaction costs, management fees, performance fees, or expenses. To make matters more complex, the presentation of fees must be carefully considered in light of regulatory requirements. No cash balance or cash flow is included in the calculation, which can further distort the results. So, what does this mean for investors? The key takeaway is that back-tested performance should be viewed with a critical eye, considering the assumptions and limitations that underlie the model. As we move forward, it's time to ask some tough questions. How can we trust back-tested results, given their limitations? Should we be relying on these models to make investment decisions? Or are there better approaches? We want to hear from you. Share your thoughts in the comments below. Do you think back-tested performance is a reliable indicator of future results, or are there other factors at play? Let's spark a conversation and explore the complexities of financial modeling together. In conclusion, the acquisition of CyberCX by Accenture is just the tip of the iceberg. As we delve into the world of finance, it's essential to understand the nuances of back-tested performance and the limitations that come with it. By acknowledging these complexities and encouraging open discussion, we can work towards a more informed and critically thinking investment community.